Hey everyone, it's GoldTrader097 and welcome back to the channel. Now, have you ever looked at the Forex market and thought, man, I wish I could get a piece of that? I mean, it's a 24/7 opportunity with trillions of dollars moving around every single day. Well, you're in the right place. Today we're diving deep into the world of Forex trading strategies. We're talking about the top 10 strategies that can take you from what is a pip to, yeah, I'm consistently profitable in Forex. Okay, maybe not that fast, but you get the point. This isn't some get-rich-quick scheme. This is about giving you the tools and knowledge you need to potentially succeed in Forex. Whether you're just starting out or you've been trading for a while and you're looking to up your game, there's something here for everyone. We'll cover scalping, day trading, swing trading, the whole 9 yards. And listen, I'm not just going to throw some fancy terms at you and call it a day. We're going to break down each strategy, give you real-world examples, and talk about the pros and cons of each. Alright, let's kick things off with scalping. Now picture this. You're in and out of trades like lightning, grabbing a few pips here and there multiple times a day. You're basically the cheetah of the Forex world. That's scalping. It's all about making small profits from a large number of trades, taking advantage of those tiny price fluctuations that happen throughout the day. Now, scalping isn't for the faint of heart. You need to be laser-focused, have a rock-solid trading plan, and be comfortable with taking on a higher number of trades. Think of it like flipping houses, but instead of houses, it's currencies. One of the biggest advantages of scalping is the potential for quick profits. You're not waiting around for days or weeks for a trade to play out. You get in, you get out, and you move on to the next opportunity. However, this also means you need to be extremely disciplined with your stop-loss orders. One bad trade can wipe out a bunch of your smaller wins. A popular scalping strategy is using moving averages on a very short time frame chart, like a 1-minute chart. For example, a trader might enter a buy order when the 5-period exponential moving average crosses above the 20-period EMA, aiming for a quick 5 to 7 pip gain before exiting. They're not looking for massive moves, just consistent small wins. So, is scalping right for you? Well, if you thrive in fast-paced environments, have the discipline to stick to your plan, and can handle the pressure of making quick decisions, then scalping might be worth exploring. But remember, it's crucial to start small, practice on a demo account, and really understand the risks involved before you dive headfirst into the world of scalping. Now, let's shift gears and talk about day trading. This is probably one of the most well-known Forex trading strategies, and for good reason. It's all about capturing profits from the daily price movements of currency pairs. Think of it like surfing, but instead of waves, you're riding the ups and downs of the market within a single trading day. The beauty of day trading is that you're not holding any positions overnight, which means you're not exposed to the risk of the market moving against you while you're sleeping. And trust me, that's a good feeling. However, it also requires a significant time commitment. You need to be glued to your charts during your preferred trading sessions to identify those opportunities. Day traders often use technical analysis tools like candlestick patterns, support and resistance levels, and indicators like the Relative Strength Index, RSI, to make trading decisions. For example, let's say you're looking at the GBP-USD pair on a 30-minute chart. You spot a bullish engulfing candlestick pattern forming at a key support level, indicating a potential reversal and a buying opportunity. You enter a buy order and aim to exit before the end of the trading session, ideally with a 15 to 20 pip profit. Remember, day trading, like any other strategy, comes with its own set of risks. It's crucial to have a well-defined trading plan, manage your risk effectively, and be prepared for losses. Because trust me, they will happen. It's not about winning every trade, it's about winning more than you lose. If you're someone who enjoys the excitement of the market, has the time to dedicate to monitoring charts, and can handle the pressure of making quick decisions, day trading might be a good fit for you. But remember, start small, practice on a demo account, and never stop learning. Alright, let's talk about swing trading. The strategy for those who like to ride the waves of the market but aren't glued to their screens all day. Imagine you're a surfer who identifies the perfect swell, paddles out, catches the wave, enjoys the ride, and then paddles back out for the next one. That's swing trading in a nutshell. It's all about capturing those medium-term price swings that happen over a few days or even weeks. You're not trying to time the market perfectly. You're looking for those bigger moves that can potentially yield significant returns. Swing traders often use a combination of technical and fundamental analysis to identify trading opportunities. They might look for chart patterns like head and shoulders, double tops, or triangles on daily or weekly charts. For example, let's say you're looking at the USD-JPY pair and you spot a double top pattern forming near a key resistance level on the daily chart. This could be a signal that the uptrend is weakening and a potential short trade is setting up. You enter a sell order aiming for a 50-pip drop over the next few days or weeks, depending on how the trade develops. One of the biggest advantages of swing trading is that it requires less time commitment than scalping or day trading. You don't need to be glued to your screen all day, just check in a few times a day or even less, depending on your trading style. However, you need to be comfortable with holding trades for longer periods and potentially weathering some market noise along the way. If you're someone who prefers a more laid-back approach to trading, enjoys analyzing both technical and fundamental factors, and has the patience to let trades play out over time, then swing trading might be the perfect strategy for you. Now, let's talk about position trading. The strategy for those who like to think long-term, like really long-term. Forget about those quick scalps, or even those swing trades that last a few weeks. We're talking about holding trades for months, sometimes even years. Think of it like investing in real estate, but instead of properties, you're investing in the future value of a currency pair. Position traders are like the Warren Buffetts of the Forex world. They're in it for the long haul, aiming to profit from those major market trends that can take months or even years to unfold. They're not concerned with the day-to-day fluctuations. They're looking at the bigger picture, the macroeconomic factors that drive currency movements in the long run. They might look at things like interest rate differentials, economic growth prospects, geopolitical events, and even commodity prices to get a sense of where a currency pair might be headed in the long term. For example, let's say you believe that the Australian economy is poised for strong growth due to rising commodity prices and a hawkish Reserve Bank of Australia. You might consider buying the AUD-USD pair, expecting the Australian dollar to strengthen against the US dollar over the next few months. They'd likely use weekly or even monthly charts to identify trends and key support and resistance levels. Position trading requires a lot of patience and discipline. You need to be able to stomach those inevitable drawdowns that come with any long-term investment strategy. But if you're right about the overall trend, the potential rewards can be substantial. If you're someone who enjoys analyzing macroeconomic trends,